But can you just explain the issues around the provisioning? I understand it may be linked to Nine Mobile, and what can we expect going forward?
Thank you very much for having me. I think the first point to make with respect to the 2017 result is that all the operating entities turned in very decent numbers. And overall, we saw a growth, right, in the gross earnings, and we grew by 2.3%. And also PBT turned in a hefty 1.7% increase, and PAT was also up 179%. So that's pretty decent. Okay, and as you begin to walk down, you see that 2017 was very challenging. We saw recession for the most part, and that therefore affected the growth in the loan book, right? We are down 4%. Okay, so but the point around impairment, yes, we had to take additional impairment charge on Nine Mobile, which was industry-wide, as you know. And also the fact has to be made that there was a translation impact where we used 330 naira, to the dollar, versus the prior year that was 306. So that had a very huge impact also on the NPL. But overall, let's be guided by the developments 2018 and the projections. We think that 2018 will be far better than last year, and therefore we are likely to see a growth in the loan book between 7 to 10% we are guiding the market. So this year will turn out to be a lot better with respect to the NPL. All
right. So that 7 to 10% growth in the loan book, I think, is quite significant because, as you mentioned, we saw a decline in the loan book last year. What will be the key drivers of that increase in loan creation? Because now that we're seeing a decline in yields in the fixed income market, there is that expectation that the banks will move maybe more aggressively into creating risk assets. Is that really what is underlying this move?
Okay, so I will agree that we benefited from a high yield environment last year, okay, and we saw clearly that there was a migration to fixed income and also to investment securities. But the prognosis this year is a lot better because we're going to see an all-inclusive growth in the economy. And so we see opportunities in manufacturing, we see opportunities in consumer lending, we see opportunities in general commerce, and of course, we see infra as also an area we can focus on. And because of the expertise we've built, cutting across the commercial bank and also the investment banking, the merchant bank franchise, we are going to take advantage of the emerging opportunities across the spectrum. So for us, it's not localized to a sector. We have the customer base, and we've got the spread, we've got the brand recognition, and so we see opportunities for the group to benefit from the trends for 2018.
Right. So clearly an increase in the loan book should improve earnings. But as we've mentioned, there is that declining yield environment, which some analysts are a bit concerned about what's the likely impact on earnings. What are you guiding the market in terms of earnings this year, in terms of profit growth?
Well, we will certainly do far better than we did last year. Last year, we closed PBT.
So strong double-digit growth this year?
We see that. We see that. I mean, it was 147% PBT growth. And so we sustained the improvement in the growth rates. And, of course, we know the issues with the commercial bank. And as the loan book is cleaned up and they have a huge buffer capital-wise, they're going to come back into lending. Last year, we dropped 4% in terms of the loan book. We didn't grow as we planned. But this year is going to be massive. And with its huge customer base, the commercial bank would obviously become a lot more aggressive in the areas I had mentioned. Now, the merchant bank and asset management group is also a key and critical sector for us. And we do think that we've got, again, some distinct advantage over the competition. And so we are going to see a whole lot more coming through the commercial and asset management group. But let me also back up and say that with respect to the insurance division, which has to be called out, we've seen an aggressive growth coming through year on year. And last year we grew by 51%, the gross premium written. And so these are areas that will help, to impact the profit for the group in 2018.
Right, and you've obviously started speaking about the various subsidiaries in the group. So give us a sense of where the group is going, say, in the next 2 years, because obviously investors invest for the long term. there has been a very rough patch for the group over the last 2 years, but it appears that we're certainly coming out of that. What are you guiding in terms of the prospects for the business?
So first of all, let's agree that restructuring through a holding company was a masterstroke, because effectively the challenges we are dealing with in the commercial bank, we appear to have insulated the other business areas, and so they're performing very, very well. And so we are guiding to improve performance across the group. That's one. Two, we also see that because we have dealt with the issues around governance, process, people in the loan, in the risk area, we're not likely to see fresh NPL formations. And you see that in the cost of risk. Because for last year, we had 10.4% cost of risk, and it has dropped now to about 6.4%. All right, it's going to trend down. All right, so the guidance we're giving to the market with respect to cost of risk is that for 2018, we're likely to see a further reduction to below 5, and then for next year, 2019, based on our 3-year strategic plan, which we're implementing very religiously, we think we will be below 2% for cost of risk, right? The NPL, we believe we can walk through because there's a concentration of the NPL. Okay, the top 20 will give about 91% of NPL. And if you unpack that further, the top 3 is about 51, 52%. So resolving 1 or 2 takes us down to a single-digit NPL.
If you can stay on that NPL issue, I think the prospect for write-backs is one that can obviously boost earnings. As the economy improves, do you anticipate that there's the prospect for that in the next year or so?
Definitely. And, market was soft. We have assets we could easily have realized, but you don't want to sell at very high discount or haircut. So we think that the improvement in the economy will obviously translate to better pricing on the assets, which obviously we'll have to sell. And then there's going to be some write-back. We will do that. We're working our way through the accounts one by one. But if you look at the trend, we have seen 1 or 2 resolved effectively. And we think that this year we're going to sell assets and recover, so there will be write-back, which will improve our NPL ratios and the overall quality of the loan book. But clearly, we will benefit from improved economy this year.